I think the next kind of leg of this inflation will be rent driven. Some areas are still in lockdown, so that's actually still holding down like energy prices. They're not as high as they could be if there was actually, say a full unlocking.
So there was recently a big CPI print of 5.4% on an annualized basis for the US. So I'd love to start there. What are your initial thoughts on that?
Yeah, so it came in a little bit higher than I was expecting, but overall, I've been in the more inflationary camp. So there, if you follow people in the macro world, there have been some people that are expecting more types of disinflation, whereas there are a number of us are expecting a higher degree of inflation. And so overall, this is roughly going along with what I expected in terms of the types of outcomes we get from the policies we've seen over the past year to 18 months. And so basically, we got a very high CPI print in the US. We got, I believe it was 5.4%. Even other measures of inflation generally came in hotter than economists were expecting. And there's certain categories that are contributing to that, right? So basically, my overall framework for the type of inflation we're getting is that this is a very fiscal driven type of inflation. So, because of the large amount of stimulus we've had, we've increased the broad money supply by quite a bit, which is different than just increasing base money or Fed balance sheet. We're actually increasing the broad money supply, so money that's available for people's checking accounts, savings accounts, currency in circulation. And so when you get that increase in broad money supply, we've improved people's demand, right? So we've given them money they didn't otherwise have, and so they can go out and expend it. But we haven't increased the amount of goods and services by a corresponding amount. And so we're specifically running into bottlenecks wherever there's a supply constraint. So an example where we're not running into bottlenecks is like men's suits, for example. They're actually it's still in deflating. And so there's no issue there, but there's an issue in certain things like semiconductors. So that's going up the supply chain into automobiles and especially used automobiles because there's constraint in new automobile production, and so that raises the cost of existing cars and light vehicles. And we're also, of course, seeing energy prices warm up. We've seen commodity prices, some of them spiked and came back down due to very specific bottlenecks, but we generally have a higher price level of commodities than we had in the past several years. And so one of the things I'm looking at going forward is that a lot of this inflation happened without rent increases going up by a dramatic amount. And yet we've had, of course, house price inflation and the cost of building materials go up. And so when you look later this autumn, I think the next kind of leg of this inflation will be rent driven in large part. And we also have to see what happens with wages because we're also seeing a labor shortage in certain industries. And so overall, the year-over-year comparison is still looking at, say, a somewhat of a disinflationary period from last year. That kind of that May to June period was prices took a dip. But as we move out of that, the year-over-year comparison gets a little bit harder. So we could see that year-over-year figure go down a little bit. However, we still have these other underlying things like rents, I think, that are going to kind of keep that elevated and probably above expectations for a while.
Yeah, so great points you're making there around how money is not neutral and therefore inflation is not necessarily equal across every different kind of product or industry or what we're looking at. And so, as you rightly say, the price of some things is still going down, but the price of other things, quite important things like semiconductors, is still rising. And so, I think the interesting question as well is now, historically, people from the Austrian camp have been sort of saying, "Oh, very, very high inflation," but it could also be that it might not be like hyperinflation; it just might be like slightly higher inflation than what we've historically seen in the more 3% range. Is that essentially your view that we're going to see high, but not crazy high inflation going forward in the sort of medium term?
Yes, that's how I'm viewing it, but there are upcoming decision points to watch. And so, overall, my view is that the amount of inflation will partially correspond to how much fiscal stimulus we get. And so we already had a certain amount, and that is still working its way through the system, especially as we come out of lockdowns in some cases. while some areas are still in lockdown. So that's actually still holding down certain things like energy prices. They're not as high as they could be if there was actually, say a full unlocking. But basically, we have certain constraints still in place. But and this is still rippling through the system. So we have to see what happens with wages. We have to see what happens with rents. But for let's say, for example, just fiscal stimulus stops right now. Because of how much debt is in the system, I think we would see those levels come back down to some extent. However, if we do more rounds of fiscal stimulus, then we'll probably get ongoing inflation. Of course, that comes with certain trade-offs. And so if they don't do fiscal stimulus because there's so much they build up so much debt in the system, then you have more default risk and recession risk. But if you do that stimulus, then you run the risk of having some areas are still in lockdown, so that's actually still holding down certain things like energy prices. They're not as high as they could be if there was actually, say a full unlocking. But basically, we have certain constraints still in place. But and this is still rippling through the system. So we have to see what happens with wages. We have to see what happens with rents. But for let's say, for example, just fiscal stimulus stops right now. Because of how much debt is in the system, I think we would see those levels come back down to some extent. However, if we do more rounds of fiscal stimulus, then we'll probably get ongoing inflation. Of course, that comes with certain trade-offs. And so if they don't do fiscal stimulus because there's so much they build up so much debt in the system, then you have more default risk and recession risk. But if you do that stimulus, then you run the risk of having another burst of inflation and continuing to run hot. And so there's kind of a couple decision points that I'm monitoring to see how long I would expect this period to go and how high it could reach.
Yeah, good explanation there. And so I'm also curious then how you think that will play out into other markets. And I think an important one is the bond market because historically it has been seen like bonds were the defensive play. And yet now, because of inflation rising, it means the real return for a bond investor is coming down. So, how do you see that? And also, there is that recent. I believe it was the 10-year where there was a recent uh, rise in the uh, interest rate there. So, how do you believe the inflation story coming is going to play out into the bond market?
So overall, yeah, this is not a very attractive environment to be holding bonds or cash. And so that's one of those things where even in a moderate inflation environment, however you want to define that, let's say 3 to 5% inflation, rather than say, 15% inflation. Let's say you have 3%, 4%, 5%. If interest rates are like 0 or 1%, you're getting devalued on your purchasing power by holding that. And of course, there are other ways to measure inflation, right? So there are arguments about how accurate those CPI measurements are. So the real measure could be somewhat above those figures, and yet your rates are still 0 to 1%, and you're getting devalued. And so that's one of the bigger challenges. We also, one of the complexities is that historically the market uses bond signals to judge what's happening in the economy. And so, for example, when you have a steep yield curve and bond yields are rising on the long end of the curve, that generally means that the economy expects more inflation, more growth, right? Because they want to go into riskier assets. And so that's up to a certain point, that's a good thing. Towards the end of a business cycle, historically, we started to see that long end bonds start to go down because the market is starting to sense that there's less growth coming and that they prefer to hold some of these higher, longer duration treasury assets. They're expecting the central bank to cut interest rates on the short end of the curve, and so they're going ahead and buying some of those long duration assets. Now, the tricky thing now is that because the central banks are large buyers of those treasuries, that's basically adding a kind of like a complex signal to those bond markets. And so we've seen, for example, that we started to see bond yields rising earlier this year, in anticipation of higher inflation and things like that, especially when we saw, copper and lumber spiking. But then we've seen some of a cool off in a handful of those commodities, and we've also seen bond yields come back down part of the way. So bond yields have actually cooled off, even though inflation's higher this month than it was last month. Bond yields are actually lower than they were last month, and so we've seen kind of conflicting signals. And so some market participants are expecting that they're saying, oh, the bond market knows this is transitory. It's looking down for inflation to come down. But that's with the caveat that the Fed is still the largest buyer of treasuries. and that's true for many central banks around the world. And so the ECB's, the biggest buyer of those sovereigns, and that's true for most developed countries in the world where they're kind of eating their own cooking.